Hello, this is Dean Curnutt, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry.
On this special 3-year anniversary episode of the Alpha Exchange, we turn the tables and your host, Dean Curnutt, is the guest. In conversation with dear friend Arthur Kaz, Dean shares perspectives developed over 30 years in financial markets. Through the discussion, we learn of a risk framework focused on understanding the why of volatility events and how this study led to Dean's founding of Macro Risk Advisors in 2008. Asked by Arthur to share a few war stories, Dean tells us of how a surge in implied volatility during the financial crisis caused certain call options to actually rise in value even as the stock plunged. With regard to market risk today, Dean has strong views on the risks of an unfriendly Fed, especially given the many signs of valuation froth that are easy to see. Lastly, Arthur and Dean talk about MacroMinds, a charitable organization Dean created in 2019 to support causes that expand educational opportunities for students. With a very successful launch event in 2021, Dean is looking forward to hosting the 2022 symposium in person, bringing the investment community together to learn and make an impact. We hope you enjoyed this episode of the Alpha Exchange, a conversation with Dean Curnutt.
This is Arthur Kaz, and welcome to the Alpha Exchange. Today, my guest is Dean Curnutt, who lists as one of his many accomplishments the creation of the Alpha Exchange. So, Dean, welcome.
Arthur, excellent to be a guest on the Alpha Exchange, and fun to do this on the 3-year anniversary of creating the podcast. And you were among the very first guests. So it's wonderful to turn the tables a little bit, and I'm looking forward to the conversation.
Where did you find the inspiration for the Alpha Exchange?
Well, I started listening to podcasts a couple years ago, mostly in finance, a couple of true crime stories thrown in there along the way as well. And of course, got to listen to Bill Burr's podcast. But I mostly listened to it for just learning about markets and doing some deep dives into specific subject matters. And what I found is that when the conversation is done well, it really is an opportunity to learn and hear from experts. And I think it's very differentiated from the very quick hit sound bites you see on news channels, which are just necessarily going to be shorter and very top line. What I found in some of the markets-oriented podcasts were an excellent conversation. And again, when it works, it's between two subject matter experts that are exchanging views, and it gives the listener really an opportunity to dive in.
Well, as a frequent listener, I think that the content is always so informative. It's so interesting to hear, people say things that sometimes can kind of change your own thoughts and your own perspectives, your established views. So look, over the years, you've done a lot of writing on the topic of crisis. You've done a lot of writing on the pricing of risk, its relationship with carry. Oftentimes, I think you're, a good interpreter of what the markets are saying or trying to say. Take us back to the beginning, if you would. And for the listeners who aren't familiar with your career path, or especially for those of us who didn't carry your statistics class in business school, highlight for us some of the major milestones when you first found yourself impassioned for all things macro risk.
Well, yeah, I do count as one of my largest achievements was getting you through that 1995 statistics class at the University of Chicago. But there are some other proud moments as well. But no, I'll take you back to the beginning. For me, it was really in college. I started to recognize that finance and economics were of interest to me. I thought that they made sense. They were consistent with a worldview I had on markets and freedom and just the motivation that folks have typically, which is just drawn towards profits and achievement. And I thought that economics did a good job of describing sort of the world from a theoretical standpoint. And finance I found to be even more practical in the sense that you're dealing in markets and market prices. And so that really started to become something for me as I progressed through college. And by, I think, 1989, so I started college in 1987, of course, the stock market crashed a month after I started college. And so I came about an opportunity to write a thesis on the stock market crash of 1987. And that really just took me. I got hold of the Brady report, which was effectively the car crash report. How did this happen document, which we see time and time again, whether it's LTCM or the nat gas crisis in 2006 and 7. So there's always a document at the end that's a question of how did this happen? And so the Brady report was really a deep dive into the factors that came together and caused this just epic collapse in markets and prices. And I'd also started studying the Black-Scholes model and options theory. And really what the crash and studying the crash helped me to understand very quickly was this idea that you can create a model that describes the world. It can be a good model, it can be theoretically sound, but it's just a model, and that markets are just prone to incredible bouts of volatility that something like the normal distribution is just not even close to being able to capture. So that really got me started. That I moved to Nomura Securities. I spent a couple of years there in economic research supporting the chief economist. I went to business school at the University of Chicago where you and I met, and really used the time there to dive into the study of options and markets in general. I left Chicago and was at Lehman Brothers for 4 years, and then I was at B of A for 7 years, and then I started the firm that I run, Macro Risk Advisors, in 2008, really during the crisis. And as an independent boutique broker-dealer, very focused on helping folks manage risk through optionality, designing trades that we think are effective uses of option premium. And as you mentioned a couple years ago, just decided to start this podcast as well. So it's great to be on it.
Terrific. I think any one of those things would have been a top-line resume builder, but it's amazing that you've got over 3 decades in the business and you've been able to span all these things. Let me take you back. So you were inspired by the Brady report. You go to the University of Chicago, study under the Nobel laureate Eugene Fama, and then end up on the Lehman trading desk. I guess in some sense you're on the ground floor of the listed options business. This is the late 90s. Tell us now, with the benefit of a little bit of hindsight, and I know this is an open-ended question, but that business has evolved a lot over time. I mean, today we see volumes in listed options. Well, it's interesting. We see both volumes and lot sizes that were never before imaginable. But tell us, with a bit of history here, what do you see as the evolution of that business and where it may be headed?
Well, let me actually answer that question, but start with a little bit more color on my time at Lehman Brothers, because that time was generally spent next to the listed options desk, but not as part of the listed options desk. I focused more on OTC derivatives. And my big assignment was covering long-term capital management. And I think that we're all, in some sense, colored by the early days in our career. So I think for folks that perhaps start and there's a crisis right away, I think that stays with them. I think that it tends to shape their risk philosophy, perhaps forever. And then I would say the opposite's also true. When folks start in markets that are especially benign for a long period of time, they perhaps see markets as just free rein on generating carry. They're not appreciative of what can go wrong. And so for me, starting in 96, we had Asian contagion in 97. VIX got to 35. It was a substantial event and really an appetizer for what would happen in the summer of 1998. And again, just thinking about back to this Black-Scholes idea and it being a guide for how to price options, but not necessarily applying to what can happen. And so what was so interesting about that period at Lehman in 1998 was to see how dislocated prices that were beforehand governed by a very even process that didn't move by much. And those assets might be things like swap spreads. It might be the spread between the 30-year off the run and 30-year on the run bond. And it certainly could be something like implied volatility. I'll never forget looking at the screens, the listed option screens in August of 1998 and seeing 2-year S&P vol bid at 45 and saying, this is just something I never thought I would see before. And so really what that event did for me was put in my mind this idea that markets are a lot of things, but they are beholden to the participants and the trades that live within the marketplace. And so what I always say about LTCM is the portfolio itself, this giant behemoth portfolio of every last carry trade you could imagine, became the risk in the marketplace. How are we going to bring this portfolio, safely land this thing without it toppling over Lehman Brothers and Merrill Lynch and others who had extended just vast amounts of credit to the fund? So it was a great first example in reflexivity and this idea that the trades matter and the participants who have these trades on matter as well. Are they very mark-to-market sensitive? Are they as close as you can be to hold to maturity? In the case of short volatility, there's a real reflexive element to these trades that they go wrong with a lot of leverage, and the need to stem the damage can cause the damage to get worse. You're trying to buy back something, i.e., let's call it a short straddle, and the very act of you covering it creates the bid to implied volatility that just makes things worse and can create lots of knock-on effects. So that was just an early recognition for me, just in the sense that markets and the trades that live within the markets are entirely connected.
Yes. Yeah. The procyclical, I think you call it the unvirtuous cycle at times. That's very interesting that you should put the historical framework about long-term capital management and the Brady Report, frankly. I hadn't heard that story from you. I thought I'd heard all of your stories by this time. But we are the byproduct of our formative experiences. I think you're kind of channeling a little bit of Malcolm Gladwell, his outliers, that our starting points can end up having great impact on our trajectories, because you're starting at in Lehman Brothers when the OTC business is moving into a much larger listed options business. So, Dean, you've talked to us about LTCM and the OTC business. You've also been around the listed options business for 25 years. And we all hear themes about the emergence of retail, the explosion of trades with one contract in size, the shortening of maturities. But tell us a little bit about your take on the here and now of that business, please.
Well, technology has just been a force in basically every business. But I'll tell you, in the securities business, and specifically the listed options business, I think technology has really changed the game. So if you go back 25 years, you had 5 or 6 physical floors where people would crowd around different areas, whether it was Microsoft or S&P 500 options or Dell or Exxon, and there were crowds of folks, and you would bring an order into that crowd to try to get it executed. There were posted pieces of liquidity by strike that you would see. You might say, okay, wow, there's 150 contracts offered there on the SIBO in some out-of-the-money put in Microsoft, and it felt mispriced. So you'd rush and you'd call down to the floor and you'd go to try to buy it at that price, and invariably something would happen along the way. It was typically a market maker denying the trade because perhaps his or her risk system wasn't updated, and basically they tell you, take a walk, that price isn't right. Over time, again, the advent of much more technology in these marketplaces and in the options market has allowed you to either post or take liquidity instantaneously through electronic trading. And it is just wicked good. And the speed with which you can execute and the degree of price discovery that you can experience across all expirations, across all strike prices, it's amazing. You'll see the posted liquidity. You'll send an order down, again, electronically. And these systems have gotten so advanced, they're so fast and smart that they can take liquidity across multiple exchanges instantaneously. And it's a fantastic vehicle to trade. The US listed options market is what every options market ought to be. It's transparent, it's fast, it's intermediated by a central counterparty. So if I get into a trade with electronically, I certainly have no understanding of who is on the other side of it, nor do I care. I don't need that counterparty to get out. So that's very different from OTC derivatives. And what's just very important is this screen-based price discovery is of value. It allows us to appreciate changes in pricing dynamics real time. And there aren't a lot of other markets that do it as well. We can see changes in term structure, changes in strike skew, changes in levels of vol and relative levels of vol. All of these things come at us instantaneously. And so one of the things that's happened just, again, over time, and perhaps it's a subset of what we all experience, which is the quick hit, whether it's watching an entire basketball game through highlights on Twitter, our attention spans are shorter and shorter. Well, in the options market, the maturities have just gotten shorter and shorter, compressed. I would say 25 years ago, the average trade might have been 4 to 8 months in expiration. And over time, that's gotten shortened with the advent of things like weekly options. You look at your options montage today, you'll see an options expiry just about every day of the week, certainly 3 days per week. And it's just a way of expressing a view in a very condensed time period. The options feel cheap because they're so short dated, the premiums are very low. But what they've done is they've invited this new counterparty into the market, which is retail. Retail was a big part of the markets in the 90s, and then it became much more of an institutional market. And I would say, and I don't have the stats in front of me, but again, the advent of retail as a force in the options market is a new thing, and it's quite sizable and important.
Mm-hmm, mm-hmm. It's interesting when you've got commission-free trading on phones, what that invites people to do. So, we saw things this year that we never thought possible, with the Reddit meme phenomenon.
I think the meme phenomenon and Reddit has just been incredible. And Arthur, you and I have known each other for so long, and we were doing options trades during the tech bubble, and there were message boards and so forth. But the degree to which Reddit has become this almost weaponized form of information sharing and the squeezes, the up squeezes in these stocks that we saw earlier this year, it's just, there's no textbook, there's nothing that we could have imagined that would be so powerful. And what I say is, in aggregation, things can really add up. And what I mean by that is, we talked about LTCM. The behemoth in the market was short just such a gigantic amount of equity vol, swap spreads, all of these things in size that formidable, very large size, this counterparty. But a single entity is nothing relative to hundreds of thousands of small entities at once, especially when they're all doing the same thing, right? So the retail trade is a likeness of the footprint, that there's a high degree of correlation in terms of what folks are doing at the same time, which is it's the out of the money, very short dated call that's being bought by retail. So you buy 2 contracts, I buy 2 contracts, and then 100,000 of our friends do the same thing. Boy, you've got quite a big trade there, right?
Yeah.
And that's the
Well, they don't even have to be your friends. They just have to be logged into the same channel that you're on. It is fascinating to think about how connected these market participants have become thanks to things like Reddit. And certainly there are some experienced hedge fund managers that have learned this lesson the hard way. So let me take that as a chance to ask you, Dean, from your history and experience in being in the markets, we all have our favorite stories. We all have stories that start with, I'll never forget the day when I saw this. It might be unfair because you probably have a few to pick from, but entertain me. What can you tell us about something that you lived through that that when you were seeing it, you knew there was history being written?
I'll give you a couple of examples. A couple of them are just the Black-Scholes model as we know it breaks. So one was, and we talked about this accountancy crisis in 2002, Tyco was really at the forefront of that. And the credit spread, the CDS spread, had just ballooned out, and the equity was high relative to the amount of yield you could generate, the carry you could generate by selling CDS. And so there was the advent of the capital structure arbitrage trade. And certain derivatives desks really were not set up in some ways to service these folks, because what we learned, and we learned the hard way, was that the appetite to buy very long dated, very far out of the money puts was in a size that was vastly greater than you'd expect. So if you're pricing something and you're a sell-side trader, you're trying to price the vol relative to the realized and so forth, but you also need to understand how much is going to be bought. You don't want to just sell 1,000 contracts and then have 50,000 bought behind it, because they're only going to be bought at a higher and higher implied volatility. And so with the cap structure arbitrage trade, and specifically in Tyco, I remember we were selling the Jan 04 5-strike put, and it seemed like a very high vol. It was something like a 60 vol. And I just remember watching the stock actually go up, and the put price went up as well. And it was really just supply demand. There was so much demand for these options because the CDS set up as a sale versus the premium to be paid on out for these teeny puts. So it was sort of a positive delta put. And a similar sort of thing happened during the financial crisis right before it truly hit, which is I was covering an account that was short financials in just giant size, and one of which was Goldman Sachs, just short the stock. And so I looked at it and I said, why don't we buy the 130 strike call on Goldman just to hedge, just as a, who knows? I mean, these things were moving around a ton. And just as soon as we finished buying it, the stock imploded. There was some news event that came out. You know how hairy the tape was back then. And I sort of looked back at these calls that we had just bought, and I was just shocked. The stock went down something like 15. It went down from maybe 110 to 95. And these 130 calls went up in value. And I called the account. I said, you're not going to believe this. These calls are worth more. And it's just the Vega. It's the implied
The Vega
vol.
swamped the Delta. Yeah.
Exactly. Yeah. And so, again, it just shows you the power of some of these Greeks, the mark-to-market power of some of the Greeks can overwhelm what the model would tell you, right?
That's a great story. That's a great story. Not every day that you get to see something like that. So that's great. When you see cap structure arb players in the market, you do get a lot of unusual outcomes. Any others that you want to talk about? Any others that you can tell us about?
Well, I always just love the process of connecting with a client and then working with the trading desk to try to find that right clearing price. And one of the trades that was truly a special one for me and for our desk was, I want to say it's early 2003. So the tech bubble had crashed. Tech had crashed. And I want to say the Qs were in the 30s. And client had a big tech book, had a bunch of huge single name shorts on in tech. And head trader, good friend of mine, calls me up and says, listen, my guy wants to buy some triple Q calls to hedge a short. And I said, okay, what kind of size you're looking at? He says, about 5 million. So I said, all right, looked at the Qs, and Qs are $30 at the time. And I said, all right, it's about $1,700, a 1,700 lot. So no big deal there. And he goes, no. He wants to spend 5 million in premium. I said, oh, okay. So I look back on it, and this is a 20 to 30 cent option they're buying, and it's got about 6 days to expiration. So it turns out he wants to buy 230,000 contracts. And I just remember the head of the desk was off the desk at the time, and I said, I gotta find this guy. So it was just exciting. We got the trade in. We took a lot of risk to get it done. It was just a really clean execution, and I thought it really put us further on the map. I certainly can't confirm it, but it felt like the biggest listed options trade in one block of all time. Now, there's since been bigger ones.
No, in 2003, it very well been.
Yeah, it was a game changer for us. Now, here's the fun part. So about 3 days later, remember, this is an out-of-the-money call. It is got 7 or 6 days to expiration. So every day that goes by, the theta clock is ticking. Good for us in the sense that we're short the theta. But the account calls, it's Friday. It's a summer Friday. It's dead quiet. And it's about 2:30. And he says, my guy's at the Red Sox game, and he doesn't want to hold these Q calls over the weekend. He wants to blow out of them. And I just said to myself, this is trouble. This is going to be very difficult. We're going to have to get very lucky if this is going to work out for us, because you're in the business of servicing your clients, and there are certain trades that you have to do that are hard. And this was one where you're just not going to be able to find a lot of folks that want to buy an out-of-the-money call on a summer Friday at 2:30. And so it's going to come back our way. This is what market making is about. This is what supporting your clients is about. And so we got nicked on the delta coming back. We got certainly the time decay hurt us. We round tripped it in a hurry. It was obviously a significant commission-oriented trade. We lost money on the P&L aspect of it, but the process was clean. Everything about it was right. It just didn't happen to work out for us that time. But it was an exciting trade. And I think, just from the team's perspective, it sort of put us in a position to understand the size that the desk is able to accommodate in terms of risk-taking.
Well, that's a terrific story. And you look back at it now, a trade of that size, that probably would have showed up in the Wall Street Journal the next day as to did everybody see this one go up? That's an exciting moment.
Yeah, it was widely reported for sure.
Take us up to 2008. You started a broker-dealer probably in a year where there were more shutterings than any time in known history. Tell us about the experiences there.
I think my general philosophy on risk is to try to understand what can go wrong in markets and the extent to which that can be destabilizing. And so it's helped me over time observing these events and trading through them, advising clients through them. It's to try to derive some commonality as to how and why these events occur. And so I think about LTCM, and then I think about the, of course, tragic circumstances of 9/11, which really came about on the back end of the tech bust, which was a vol event in itself. I think about 2002, there was what I call the accountancy crisis, which was Tyco and WorldCom and Adelphia all got caught up in accounting shenanigans. And it created just a massive credit event and got the VIX to 45 in, I want to say, August of 2002.
Right. You left out Enron from that list, but yes.
Of course. Yeah, that being the biggest one. And then you had this very, very low vol period from 2003 to 2007. And a quote I've used oftentimes is that there wasn't a single day over a 4-year period when the S&P experienced a move either up or down of 2%. So that's a long time. 4 years of not a 2% move. We just had a 2% move on Friday, the day after Thanksgiving. So that's infrequency to a almost unusual and unreasonable degree. I call it accident-free finance, right? When you're in the business of selling accident insurance and there's no accidents, there's a feedback process there too. This is the other side of reflexivity, this is channeling Minsky in a big way, but it's that the good times really sow the seeds of their own demise. They invite trades that win with a high degree of frequency. And as I said, we had this long stretch of nothing really happening in markets. And that just wasn't equities, that was credit. It was incredibly benign. And so that led us into 2007. And it became clear around 2007 that things were starting to change. I spent a fair amount of time in 2006 and 7 working with counterparties, or colleagues, I should say, on the credit derivatives desk, just trying to understand the credit dynamic. And it was obvious that there were cracks in credit markets, and there was a degree of worry amongst very senior people in those businesses that, boy, this is set to end really badly. And the equity markets were, I would say, quite blind, very far behind the realities in credit. The reason I got so close with these folks in credit is because we had an inquiry from an investor on trying to hedge credit risk with variance swaps. And always thought a lot about that Merton model relationship. You and I have talked about it quite a bit. And their view was to own some equity convexity as a way of hedging credit risk. Now, remember, this was coming through a period of 2004, 5, 6. People were certainly bearish on housing and perhaps this notion that things were unsustainable. But if you got it even a year early, if you got there too early, you bled out the premium pretty quickly. And it just gets very difficult to stay the course. So when you look at someone like John Paulson, the greatest trade ever, the greatest timing ever as well, right? That's kind of what made it the greatest trade ever. So there are others that had the idea. So Going into 2007, it was very clear that things were starting to change quite dramatically. The quant crack up in August of '07 was a big deal.
Yeah, fascinating period. Doesn't get nearly enough press time these days.
Yeah, and it was interesting because it was so underneath the surface. I mean, the VIX did get into the, I want to say, mid to high 20s. Markets got incredibly illiquid, but it was because it was really the unwind of these factors more than anything else. You couldn't really see it as obviously. But, then as 2008 comes along and then the actual crisis, so I was able to, have an opportunity to go out on my own with the help of some incredible clients supporting me, and just had this idea to start a broker dealer that was uniquely focused on derivatives and thinking about the world through the lens of optionality, with the premise that doing it independently could actually be quite helpful, that having an independent vantage point in the markets would allow you to be on the same side with your clients, more so than I had seen possible during what became a very complicated 2 to 3 year period for large banks and their clients, because they all had very challenging risk positions. And it's just unclear if you can continue to support your clients in the same way when you've got a legacy of prop positions that have gone wrong. So that's what we set out to do and started the broker dealer by early 2009. So it was quite an interesting time to be striking out on my own.
Well, the risk of sounding like a biased interviewer here, I think the street's a better place for it. Thank you very, very much for that, Dean. You have seen a lot, it's clear, between the accident-free finance, as far back as long-term capital management. I remember your group, once upon a time, it produced a deck of playing cards with the infamous protagonists, the world's biggest blow-ups. And I loved it because there were all these examples of, well, here's what this guy did wrong, or, this is what that bank wasn't counting on. And it was a fascinating kind of a, trip through history, a Brady report, so to speak, of all these, we've heard of them and maybe we didn't quite get our hands around what they were. But tell me, from all of the different you could choose from, this might be a difficult question, but, Orange County, MF Global, the London Whale, who could forget AIG? Give us one of your favorites. Tell us all about it.
Wow, those are so interesting because they traverse different asset classes, and there's a lesson in each one of those. So the very first one, I started it in, I want to say 1993, was one of the famous business school case studies is Gesellschaft, which effectively lost a couple of $1 billion trying to hedge.
Right?
Yeah. Yes. And Merton Miller, so our professor from U of C, another Nobel laureate, had a great quote from that. He said, I could understand losing $1 billion speculating. I can't understand losing $1 billion hedging. And it's just it's a hedge program run amok. It's all the wrong things. It's taking term risk. It's having two securities that are supposed to hedge each other, but they don't mark to market offset each other. They were doing some stuff OTC, some stuff listed. And they also really tried to cheat by using the typically backwardated curve in crude, and that didn't work either. So
yeah, every mistake in the book, I think you could put on that business school case. I remember that one.
Yeah, but I'll give you, to me, a fascinating one, which is from the crisis itself. And the biggest loss in that is Aig Financial Products. It's the government had to put in, 80 odd billion. There's that scene from Too Big to Fail when they're trying to clean up Lehman Brothers. They know that Merrill is close as well. And there's a piece of paper that's handed to Paulson, and it's basically AIG's numbers. AIG has made the call. We're in trouble. We're not going to be able to satisfy our cash demands on Monday. And this portfolio is just gigantic. So it's a couple of things here with AIG. One is every trade is a function of not just the risks in the market, but also the regulatory construct. And for AIG, they had this kind of poison chalice of being a AAA counterparty. There were not many. Berkshire was one, AIG was another. And so you could sell CDS protection to your heart's content without any mark-to-market collateral. And not posting mark-to-market was also, at least at the beginning, that was a characteristic of a lot of the long-term capital trades. They were able to sell long-dated vol without collateral. So AIG's portfolio just got so big. So related to this was, and this is where I wanted to point to, is a gentleman by the name of Howie Hubler from Morgan Stanley. And his losses were quite significant as well. I think it's on the order of 8 billion, discussed on the Morgan Stanley earnings call. And what's so interesting to me about this case is he had the trade right initially. He was long protection against subprime CDS. Now, it was wickedly underpriced, but that doesn't mean it was not nominally expensive. It's sort of like buying 50 vol when the realize is set to be 200 vol. 50 vol is still a lot. So he's paying the freight on the negative carry, and he thinks, well, let me see if I can try to reduce some of that friction. And he winds up legging himself into the equivalent of a 1/8 put spread. He's got the top leg, the first strike, but he's sold so much of the super senior tranche protection to finance it. And of course, that was viewed as that's money good. There's no way that could ever get that far. And of course, absolutely, we got that far. So he wound up being short a lot more than he was long in terms of being exposed to the blow up. So that to me was fascinating because it shows, you can get the trade right, but we're all subject to the everyday dynamics of how things carry, and carry can be very difficult to lug, on a daily basis.
Right. And I guess Morgan Stanley, they really kind of pushed the envelope of what the market would tolerate under the circumstances. That's one that doesn't get a lot of press time either. Thank you for bringing that one up. All right, so let me ask here, because I recall back in 2017, you were, and MRA was presciently calling attention to these pro-cyclical feedback loops. And at the time it was, the VIX ETF and ETN products. These were the inverse exposure to vol, the 2x shorts. You were very much ahead of. These things could demonstrate unvirtuous cycles. And you helped call the attention to it. I don't know that enough of us listened, but that now is something that we look back at and say, oh gosh, how could that risk have been hiding in plain sight? So tell me, when you see these feedback loops, these pro-cyclical feedback loops, what are the ones that you think that maybe with the benefit of hindsight, we're going to say, hey, that was hiding in plain sight?
I think about vol events as the market's confrontation to a new reality. And so it is the size of the event is a function of a number of things. It's the degree to which the new information is different and conflicts with the embedded consensus. And the extent to which that consensus was very strong is probably a function of the capital that's represented by that consensus. And then lastly, I would throw in, when things have to happen in a hurry, that's when markets move. And so we have to differentiate the reaction function of the investors, or in this case, the mechanical product that was in the market. So again, back to an LTCM, they had to react because the margin calls got so significant. Back to AIG, they didn't have to react at first, but when suddenly they learned that because they got downgraded from AAA, they were going to have to start to post collateral. Unbelievably, by the way, they weren't even aware of what a CSA, a credit support annex, was. This is an incredible tidbit from that story, that they had become so accustomed to just doing the trades and never posting collateral that when they learned of collateral posting, they didn't even know the terminology.
Had to get up to speed in a hurry, I think.
Yeah, exactly. With the VIX product, it really also was just a function of the size of the capital that effectively became a part of this ETP complex. And the biggest one is the XIV. It's a levered short VIX product, and it has to satisfy a daily return requirement. It has to deliver 2 times the inverse move of the VIX. And it doesn't take a view. It doesn't read the paper. It's not macro aware. It's a very, very simple thing. And that mechanics really obviously was its undoing because a couple things. One, the size of the product got substantially large. This product and its brethren in the markets delivered Sharpe ratios anywhere between 3 and 5 for 2017. This was a 6.5 realized for the S&P. The VIX averaged 11.5. And so this thing got bigger and bigger. In fact, there's a story of a hedge fund manager who was in a taxi cab And the taxi cab driver started asking him questions about, what do you do? And he said, I'm in markets. And the taxi cab driver said, well, I've got this stock I really love, and this thing is amazing. It's called the XIV. And this person thought that this was actually a company, right? And it's just a mathematical construct, that does have a Sharpe ratio and was trading like water, has all the characteristics of a company, except it doesn't have a team. It's just a math product. So the two things that happened were, one, the size, and then two, the low base of the VIX. So again, coming out of 2017, the VIX spent most of the time, especially towards the back end of the year, below 10. It's incredibly interesting to see how low that VIX got. And it was still too high because the realized vol in December of 2017 was on the order of 3 or 4. So you could have sold vol at 9 and it realized 3 or 4. So you're still getting that positive carry. The risk, again, this comes back to Minsky, is that at some point you're in this trade at such a thin margin of error. And vol itself is so, again, it's so reflexive. And with respect to this XIV product and the other ones that had mechanical hedging to do, you take the VIX future from 12 and all it needs to do is go to 20. Now, that doesn't sound like a lot now. Back then, people were like, I don't know, I can't see it happening. But of course it did. So that product never would have blown up had the asset base not been so big. It really was a function of just the keyhole effect of trying to fit too many VIX futures to the close in an already skittish tape.
Well, you brought out the very famous quote from Long-Term's Victor Hagani, right, about the difference between selling hurricane insurance and selling financial hurricane insurance. I love that. If people who are here listening don't know what I'm talking about, maybe you could help us here. The difference between selling hurricane insurance and financial hurricane insurance, please.
Well, I had Victor on the podcast maybe 5 episodes ago or so, and it was fascinating because he had been introduced to me by a mutual business friend who said, Dean uses your quote a lot. I think you guys would get on well. And so we just decided to do a podcast together. And the quote is, it's during the worst part of the LTCM event where the portfolio is literally imploded. There's effectively new owners of the portfolio. Remember, the banks led by Goldman effectively took it over. And Hagani said something to the effect of, hurricane insurance and financial market insurance are not the same. In financial markets, if people know what you're doing, they'll basically front run you, and that your trades in the market become part of the risk. And I said, boy, could not be as ironic. There's no more ironic a statement you could make just given what has occurred with LTCM, or maybe the better way to say it is just, it's so appropriate. And again, it just comes back to this idea that the trades matter, the actors in the marketplace matter. A hurricane, now I know this is absent a conversation on climate change, but hurricane risk is invariant to the amount of hurricane insurance that's been written, right? Mother Nature's Mother Nature. And
doesn't care.
It doesn't care. It's going to happen. And that's, again, part of the allure of something like reinsurance is that you do have some risk premium, but it is pretty uncorrelated to the other trades in the market. So I think that's, again, it's a very interesting dynamic, and it's a critical one because the trades in the market matter so much.
We haven't yet once mentioned the Fed or the role of central banks and how it fits in the world around us. So I know that it's probably a topic that could take more than an hour in and of itself, but help us here, Dean. When you think about a world where Fed is buying corporates now, they're picking winners and losers in the fallen angel high yield space. The amount of, and I'm not trying to lead you here, but in the era of QE, I think the Fed's balance sheet expanded by at most $80 billion in a month. And here since March of 20, we saw days that the Fed was expanding its balance sheet by over $100 billion. So tell us, what do you think of the world we have here, and maybe give us a thought about where we're headed?
Well, I'll start with going back to this differentiation between hurricane insurance and market insurance. Another insight I think that is worth exploring is the idea that Mother Nature doesn't learn from the success or failure of the insurance market that's written around her. But market participants do learn. And we learn based on different events, and we learn specifically how the central banks respond. Now, there's nothing to say that central banks aren't supposed to respond forcefully to crisis episodes. There's no doubt about it that in a March of 2020, they are supposed to use every weapon they have to try to stem the tide of deleveraging that, got really scary there. There were 3 days in a row where the S&P moved 9%. 2 were down, one was down 12%, and the other was up 9%. These are levels of volatility that no market can withstand. And I honestly felt like we were very close to something that you're going to just print it down 25%. Because when you're printing down 12% and it's 340, the conditional probability of another 8% or more is extraordinarily higher than it otherwise would be, right? So I like to say vol has memory and vol mean reverts. Vol has memory means two things to me. One, low vol periods tend to reinforce each other. That 2017 period of just watching the tape each day and becoming convinced that nothing was going to happen. That period from 2003 to 2007, when I told you there wasn't a 2% move up or down in the S&P, these things matter, and they do tend to reinforce themselves because they invite a set of trades in markets that on the carry side are just basically saying the world tomorrow will look pretty much as it does today. That's a carry trade. The other trades, the non-virtuous trades, the destructive deleveraging trades of 3 straight 9% moves are so forceful, and the spillovers can be so quick that it's very difficult to know what's coming next. And that, of course, was the financial crisis, right? You just had every other day there was something new that you didn't think about. It was the leveraged loan basis trade was blowing up. It was a div swap market. It was
auction rates, yeah.
Yeah,
right.
Auction rate securities were completely frozen. I'm recalling the securities loan lending market nearly imploded. So the spillover and the connectivity amongst these markets is something we have to really appreciate. We live in a very financialized world of assets. So you come about to a March of 2020, and you and I had many conversations with each other, with others around this period where we could see that the bond market itself, the risk-free asset itself, was set to give way. There was not an additional dollar of risk-bearing capacity for any product. It was just cash. Just give me the cash. A 10-year Treasury bond becomes a risk asset in that period. And so that's when you saw the correlation flip where stocks and bonds were both falling ferociously at the same time. And so, of course, the Fed has got to step in. Now, I think the questions are always fair, and there's always going to be the Elizabeth Warren questioning Tim Geithner on AIG and making the counterparties whole during the darkest days of 2008, early 2009. It's easy to do, and there are fair questions to ask. But when things move that fast, in some sense, I do agree with what Geithner says, which is when you hit a crisis moment, you're going to have to overdo it. The only way to make sure you can put the fire out is to overdo it. And that's going to lead to some moral hazard. It's going to lead to questions about fairness. But it's also, and this is where I'm going with this differentiation versus hurricane insurance or Mother Nature, is that we see the crisis response in action. We are conditioned by the crisis response. We've talked about a number of crisis periods here. And if you go from 87, the stock market crash, to 98, to 08, to 2020, at every turn, the intervention by the central bank is much more forceful. 87, a 20% downdraft in stock prices, they issued a very prosaic statement about maintaining orderliness, and our duties as the Federal Reserve Bank is to ensure that the counterparty is functioning, et cetera. And they eased policy, of course, and so forth. 98, they brokered a deal, right, with the counterparties to inject money into long-term capital. 2008, a long list of rescue facilities, not just the Fed, but the Treasury, the FDIC did a bunch.
Do you remember Hank Paulson owns, in his first remarks about the TARP in 2008, he walked up to the podium. He didn't know what number he needed. He just knew it needed to be big. He needed it to restore confidence. And so the person tried to pin him down on this. How big? He said big. And when another reporter said, is it 500 billion? He said bigger. And so he knew that he had to, whatever the first number was going to be thrown out, he was going to top that number because it was only about restoring confidence at that point.
Yeah, and I think if you look at the lessons that we may derive from some of these episodes, so if you look at, for example, the U.S. response in 08-09, it's ugly stuff. It's difficult. And again, these are longer conversations around how and why did we get to that point, and does the Fed have a role in actually getting us to that point? You can't be the only firefighter and play a sort of some role in creating the conditions for the fire. And I think that's, to me, where I would be concerned. But you have to be forceful. Look at the uneven and vastly inadequate response from the European Central Bank in 2011. That was a crisis a weekend for a long time until philosophically Draghi came in and just had a different view on it. We will do whatever it takes.
In a sentence, right, exactly. Defend at all costs, right? Yeah. In one sentence, he put a crisis away.
So the change, though, is in March of 2020 is the QE Unlimited. And those were just a couple of words as well. It was in an amount necessary, which is we will buy as many bonds as it takes. There is no limit. It's not a number. There's whatever's necessary. And it was obviously quite substantial because we had not had a event like that before. And I asked myself, and I asked most of my podcast guests this, when we look at the VIX going to 80, when we look at the treasury market crashing, is that a function of the setup going in, i.e., are too many people short equity vol? Are too many people engaged in some leveraged bond basis trade? Is that what happened here? Or is it that this crisis was such a dramatic sudden stop? We'd never shut the economy down like this before. How do you kind of piece those two things together? And the answer is invariably, it's really a combination, right? The setup was fragile, and the Fed does have its hands in creating the conditions for that setup. And what I would say, Arthur, is the transparency of central banking, or the philosophy of transparency, I have an issue with. I think that we try to tell people what's happening in advance so we're not disruptive. And that just strikes me as overly invested in financial market outcomes. If the Fed is really to take seriously its remit, which is growth and inflation, there's a whole lot of time and energy spent on wondering how financial markets are going to react. When I started in the business in 1991, I'll never forget the entirety of the conversation was, how does the Fed win the confidence of bond markets by reducing long-dated interest rates and inflation premium? And that was a big deal. It takes a long time to earn that back. And so we could be amidst a period here where, again, amidst 1.5% nominal 10-year interest rate, we've got this inflation dynamic that's just so far above it. It could be setting up for something that's quite unfortunate if we have to do a sudden stop. We just have not had a move from the Fed that's not market friendly, I would say, since 1994. We've had a couple things. Perhaps you might throw late 2018 in the Fed tightened in December when the market kind of told them not to. But that's about it. This is a pretty market-friendly Fed.
There was a Jackson Hole headline, and was that 13? We saw where that took us, right? Well, as I had expected, you have a lot to say on the subject of the role of the central bank. So thank you very much for that perspective.
It's such an interesting environment. We talked about retail, this force in markets. It's a one-way force. These folks are not in the yield generation game. They are in the two-day lottery ticket game. It's a very leveraged, very short-dated bet that stock prices will go up in a tape where they've only gone up. So it's a little self-fulfilling. And one of the Greeks that's gotten the most play this year is this gamma, right? The second derivative. It's the delta goes up when the stock price goes up for a call. And for these very short-dated options that are the prototypical trade for retail, this feedback loop of forcing the hedger to buy the stock when the trade is initiated, the short dated call is initiated. But when the stock goes up further, that hedger having to update the hedge and buy more stock. It's hard to prove it out, but it certainly feels like you're on a circularity of feedback. You've seen it in these gamma squeezes in names like Tesla and NVIDIA. It's really fascinating. And we mentioned the tech bubble as well. One of the signature aspects from a pricing standpoint for the tech bubble was stock up, vol up. It's not something that is common in equity markets, certainly not in the S&P. You don't see the S&P go up a lot and the VIX go up a lot, right? But on the single name level, you can see it, and it's become increasingly prominent this year. We've seen these up crashes in names like GME and AMC, but one of the ones I watched recently, really amazing to look at, was NVIDIA. Stock goes up something on the order of 30% in a month, and the implied vol doubles from 35 to 70. And boy, that is a hedger's nightmare. You're short the upside call, the stock moves up ferociously, and the vol moves up against you as well. So the types of things that you were expecting to experience from a hedging standpoint, it's just a very misbehaved profile. The delta is not what you expected. You underestimated the delta. The mark to market can be quite difficult. And so what's interesting, Arthur, is that the feedback into vol surfaces is now evident. So if you look at single stock volatility surface, and what I mean by that is just across strike prices. So pick your expiration, 2-month options, and I look at across different strike prices. It's typically the case that the out-of-the-money put sometimes has a substantially higher vol than the out-of-the-money call. Stocks crash down, not up. Well, not this year. Stocks are crashing up. And so it's really interesting. You can own a stock and collar it, buy the out-of-the-money put and sell the out-of-the-money call, sometimes at very favorable levels, which I think is actually quite helpful in an environment where stocks feel very elevated. At least you have some ability to hedge. Now, of course, what are you doing? You're giving up what could be a massive amount of upside. The reason that out-of-the-money call option is so well bid is because of the up crash. So if you put your collar on and the stock crashes up, you might have only gotten the first 10% of the upside because you're short that call, right? That's the risk that you're taking. But at least from a pricing standpoint, on the day you do the trade, it's reasonable. The thing that I see most in this market and what has me concerned, I think about episodes of crisis. I spent my entire career just studying these car crashes. I find them just so fascinating because they're all a little unique, but there's typically traces of commonality in these. They rhyme in some ways. And when I look at the set of prices now, I am reminded of the tech bubble. I was just looking at the stocks in the S&P that have a market cap of more than $100 billion. So there's 86 of them, actually. And unbelievably, 34 of those 86 have an implied vol, a 3-month at-the-money implied vol of more than 30. And several of them have an implied vol north of 50, 2 of which are in the top 7 or 8 stocks, NVIDIA and Tesla. That reminds me of the tech bubble. The biggest stocks are becoming too speculative. And the other part is if you just look at the median PE of these stocks that have a PE north of 100 billion, a market cap north of 100 billion, they're very expanded PE ratios. High vol, high PE, I just think smacks of speculation. And it smacks of speculation at a time when decidedly the inflation and potentially Fed policy regime are in transition. What we knew for years and years and years, which is the Fed fighting inflation from below, is flipped. And that could go away. We should respect the lead lags and data and so forth. So I know Powell is just retiring the word transitory, but who knows? Maybe it does turn out to be transitory anyway. The Fed's reaction function is entirely different from anything we've seen in the last, again, I'm going to go back 27 years. You got to go back to 1994 to see a set of risks that the Fed's confronting that might necessitate a policy response that is vastly market unfriendly at a time when valuations are extraordinarily stretched.
Yeah, and particularly around growth themes, right? Particularly around those that have the highest sensitivity to discount rates. So I tend to agree with what you've said there, that, when you look at how many companies are out there with $100 billion market caps, I mean, look, we've got $1 trillion market caps now. We've got $2 trillion market caps now. Things that, would have seemed like fantasy just a little while ago. And, those vol surfaces, Tesla's obviously the one that comes to mind. You can't say enough things about how much that name influences things like VIX and, people's attitudes about short-term volatility. But do you think, to take you back to your comment about, the retail phenomenon and where the listed options business has gone, do you think that the Reddit community has some part to play in the street's gamma position or misgamma positioning? Do you think that there are enough, gunslingers out there doing single lots that causes these NVIDIA-type gamma squeezes?
I think so. Again, hard to prove, but when you look at option volume, it's sort of what happened to share volume. The block trades became smaller blocks and smaller still, and then ultimately they just became algorithmic trades, just chopping at the tape electronically in these little pieces. Some of that was just to split up the volume to do it more efficiently. Here you have a new constituency, and I do think it adds up because it's so one way and so short dated. So these are the very gamma intensive options. When we think about the price of anything, I think you really should be able to step back and analyze it from supply and demand. And so vol, like any asset, has got a supply aspect to it and a demand aspect to it. The supply aspect got hit pretty hard during COVID. Going into COVID, there were quite a bit of trades that were some form of short vol, short correlation, short tails. Risk recycling trades, put selling became a big thing for yield enhancement. And folks just got lazy because it worked. It worked real well. And some of these stories have been well documented. AIMCO, Alberta Investment Management Company, lost $2.5 billion selling some form of tail that involved variance swaps. There were others, again, very high profile. Allianz, a very high profile loss of a couple $2 billion. So I think about the capacity to bear convexity risk got hit. And one of the points I've made many times is that if you were long distressed or long high yield into the teeth of that crisis, boy, that was ugly. But if you didn't sell, you didn't sell. You came back. And so they don't really have maturity. Bonds, of course, have maturity. Equities don't. But these option trades, these strategies got marked out. The losses were crystallized. So that capacity to bear that risk got diminished quite a bit. And so all else equal, you take supply out, the price goes up. And then you introduce this newfound demand, this new source of demand via retail. And now you really do have a interesting supply-demand imbalance. And so I just think it's very much a part of the story of why the VIX has cleared the market. It always clears at a premium. We know about the vol risk premium, but it's been exceptionally high this year. I did some back tests through a great service called ORATS that allows you to just run back tests and just looked at simple robotic strategies of selling straddles in 2021. With a few exceptions, things like FXI have not worked out that well. That's the China ETF. Interestingly, NVIDIA has done poorly. That's just because even as the stock's done well, the vol's gone up so much that straddle selling hasn't worked. But Qs, HYG, S&P for sure, you're running Sharpe ratios of almost 2, sometimes higher. Those are really, really good. Of course, we've had a fair amount of volatility as we speak these last couple of days. So I'm sure these Sharpe ratios have come down quite a bit. But absent up until these last couple of days from this year have been those big moves that tend to cause a deterioration in that vol selling strategy. So, it's just been interesting that, the VIX has stayed high, even as realized, again, absent the last couple of days has been quite low.
Yeah, it will be interesting to see what systematic vol selling looks like going forward with the new Fed regime potentially, with stretched valuations in tech. I mean, certainly the 2 Sharpe ratios, they collect a lot of capital. But this consistent performance of that carry strategy has attracted a lot of attention. But I guess you have to see how it's going to handle in a different vol regime. Finally, I want to talk about your charitable work, and I'm referring to MacroMinds. It's fascinating that you've managed to couple high-value content into a conduit for existing philanthropy. So tell us about your vision here. And for those people who aren't familiar with MacroMinds, please put in a plug for me.
Yeah, thank you. I really enjoy hosting events. We have hosted a lot of events over the years. If you're on the sell side and you're in the client business, hosting events comes with the territory. And I've always enjoyed building events that are part content and part social, with the idea that part of the role of anyone on the sell side is not only to bring insights and content, but also to play a role in helping your clients meet each other. And so I would say some of the best feedback I've gotten from clients along the way is, hey, I've really met some very quality folks at the events that you've hosted. And I think that it's important to give people an outlet to allow them to meet each other. I had started attending and sponsoring the Iris-Own conference. This was years ago. And this was a very big event. It's devoted to a number of things, but one of which is pediatric cancer research. And the event attracts the likes of Bill Ackman and David Einhorn and Larry Robbins, and it's typically very single stock oriented. I had just had this thought probably as early as 2015 or 16 that I would like to start the Iris-Own for macro, that I very much have enjoyed playing a role in helping raise money for various causes. One of the things that I've had the opportunity to do at Macro Risk Advisors is to host a charity trading day. And over the course of, I believe it's 6 of these that we've done, we raised $2 million for various causes: veterans, children's education, various health initiatives, cancer research we were able to get behind. So that's always been fun. Again, working collaboratively with clients and finding these organizations to raise money for. And MacroMinds is sort of similar, but it's not using the trading desk. It's essentially saying, I'm going to host an event, one event per year, and I'm going to work with a couple, and I would say a couple is 3 or 4 organizations in and around the tri-state New York area that are focused in some way on the mission of expanding educational opportunities for children and students. So I really got the idea going in 2019. We got all the paperwork done, and we were set to host the first event in April of 2020. No surprise, that event did not take place in April of 2020, and I had raised some money for it. The idea was to host a day symposium with great speakers speaking on macro, on derivatives, on credit markets, and then to sell tickets and sponsorships. So we were finally able to get it off the ground in May of 2021. We did it virtually. We had a 2-day event and a really stacked card. I'm just so proud and grateful for folks lending their names, their time, and their insights to making this such a big success. And Arthur, you were one of the moderators, and I'm grateful for that. 50 sponsors, and people really stepped up. So we've got the next one scheduled. I had initially scheduled it for May 19th of 2022. And I decided I'm going to make it a 2-day event. It's going to be May 18th and 19th. It's going to be in person at the New York Times Center. And we are off to an unbelievable start. I'm just so excited to be able to do this because it's going to be in person. And 2 things, what I'd like to add is when I created this with the idea of bringing the street together to learn, and one of the things I say about our business, and maybe it's the same in other businesses, but in Wall Street, there's so many disciplines. There's so much to know. How could you possibly take this on yourself? And so we're all learning from each other. There is so much content that folks are accessing from others, whether it's through conversations or through Twitter. There is some really smart people just sharing their insights and sharing their craft, and others are getting smarter in the process. And I think that's critical for an industry that demands so much of us at this point. There's so many facets of risk and reward to be focused on. You couldn't possibly cover it all yourself. So part of my idea is is this idea of networking and building relationships among people that are like-minded and really on their games. So that's the first thing, is the bringing people together in person. Obviously, we couldn't do that this year. And that's one of the reasons why I'm so excited about next year and being able to do it in person. The second thing is the pandemic itself. As I said, I really got this going in 2019, and I had no idea that the pandemic was coming, of course. And it's just been such an awful thing. It continues to be something I think that has impacted us in ways we probably don't even realize as much anymore. But one of the most difficult circumstances, I think, has been the student, and specifically the student that comes from less, who is in a household with less economic means, who's in a community with less economic means. Those kids have found it substantially more difficult to keep up. And that's why I think MacroMinds, the timing is really important, because what we're doing is we're coming together as a community of finance professionals. We are listening to content and insights from some of the best in the business. And we're doing so in the spirit of raising money to contribute to causes that stand up for expanding educational access and opportunities for students of lesser economic circumstances. And it's just become critical to do so. So we're in the hunt for finding 3 to 4 organizations to work with. We'll pick a new set each year, but that's the focus, and just really excited and frankly honored to have an opportunity to bring this to the market.
Thank you. So once again, that's in Midtown in person. You said May 17th, 18th?
May 18th and 19th.
I wanted to say thank you for sharing the stories that we heard here today. They have been as entertaining as they have been enlightening.
Arthur, it's been a pleasure, and I appreciate you stepping in and allowing me to sit in the guest seat on the 3-year anniversary of the podcast, and it's been a lot of fun. Thanks a lot for doing it.
I will look forward to doing this again in 3 years, Dean. Thank you.
All right, talk to you. You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.